A major event has shaken the international financial community. On May 16 local time, data released by the US Treasury Department revealed a significant shift in US Treasury holdings. China has dropped from the second largest foreign holder of US debt to the third, with the UK replacing it as the second largest holder. Specifically, in March 2025, China reduced its US Treasury holdings by $18.9 billion, bringing its total to $765.4 billion and falling to third place. Meanwhile, the UK increased its holdings by $29 billion in March, reaching $779.3 billion and rising to second place. While these numbers may seem trivial at first glance, they signal a critical turning point in China's decade-long process of reducing US debt holdings and reflect profound, unprecedented changes in the international financial order, especially as 30-year US Treasury yields breach 5% and Moody's downgrades the US sovereign credit rating, triggering a power shift in the US debt market. This is the harsh reality of the de-dollarization era unfolding. Let's first analyze China's transition from a major US debt holder to a reduced position. There are three key rationales behind the reduction. Risk avoidance. US Treasuries now resemble the emperor's new clothes, ostensibly valuable but fundamentally hollow. Over the past decade, China's holdings have shrunk by nearly 40% from a peak of $1.3 trillion. Why? China's policy advisors long ago recognized the enormous risks behind US debt. The US federal debt has surpassed $36 trillion, 130% of GDP, making it the world's most indebted nation. Moody's downgrade of the US from AA to A1 has punctured the myth of treasuries as risk-free assets. As Goldman Sachs analysts warn, the US fiscal imbalance is a ticking time bomb. China is wisely reducing exposure to avoid being caught in the blast. Geopolitical gamesmanship. The US has weaponized the dollar for sanctions, such as during the 2019 US-China trade war, prompting China's strategic reduction of treasuries. This is not merely an economic move but a countermeasure. When the US froze Russian foreign reserves and wielded tariff sticks, other nations holding US debt panicked. What if my trillions in treasuries become worthless overnight if the US sanctions me? This insecurity accelerated de-dollarization. China refuses to be held hostage by dollar hegemony and is adopting proactive strategies. Asset reconfiguration. As China reduces treasuries, it is simultaneously increasing gold reserves, which reached 73.77 million ounces in April. Gold is tangible hard currency, a stark contrast to the paper credit of the dollar. Concurrently, RMB internationalization is progressing, a metaphor for strategic transformation from relying on US dollar trust to embracing tangible assets and an independent currency system. As the state administration of foreign exchange notes, growing foreign demand for RMB assets signals a historic reversal in global capital flows and the rising international status of the yuan. Now, let's examine the surge in US Treasury yields. Is this a boon or a trap? Recent days saw 30-year Treasury yields break 5%, the highest since the 2008 financial crisis. On the surface, this appears as a triumph of Trump's tax cuts stimulating the economy, but beneath it lie three hidden crises. Fiscal black hole. The tax cuts could add $3.7 trillion to the deficit over 10 years, building economic prosperity on a foundation of debt like constructing a skyscraper on sand. Stagflation persistence. With core PC inflation still above the 2% target, the Fed must maintain high rates, administering a strong medicine to the economy with severe side effects. Trust collapse. Global central banks have sold treasuries for 17 consecutive months, including US allies like the EU and Japan. While hedge funds celebrate rising yields, risks are quietly accumulating. BlackRock warns that higher long-term yields will raise corporate financing costs and exacerbate recession risks. Paradoxically, despite foreign holdings of $9.05 trillion in treasuries, demand is weakening. April trading data showed declining overseas appetite, echoing Wall Street's adage, "When even fools are buying, the party is ending." What does a 5% 30-year treasury yield signify? It means the US capital market believes low-interest environments will be absent for the next 30 years. After weighing all possibilities of future rate hikes and cuts, the market concludes that a 5% yield is the minimum to entice 30-year lending. Otherwise, investors would prefer short-term for 0.5% yields, anticipating higher rates later. This kind of judgment is terrifying, suggesting that high interest rates in the US are likely to persist long-term, with no return to low-rate environments for many years. As is well known, there are only 3 scenarios under which a country maintains long-term high interest rates. First, skyrocketing prices and runaway inflation. Once inflation exceeds 5%, interest rates must rise to contain it, lest hyperinflation erupt. Second, rapid currency depreciation. For a currency losing 20% of its value annually, even a 20% interest rate holds no appeal, forcing government bond yields to start at minimum 20%. Inevitably accompanied by hyperinflation, as prices would rise at least 20% annually. The third scenario is the rarest: a country with extremely strong, overheating economic growth, where sky-high investment returns make low bond yields unattractive. Capital can easily earn far more than bond rates, necessitating high yields to attract buyers. For a normal country without inflation, currency collapse, or overheating, the default policy is to cut rates to stimulate growth. Deflationary economies even aim for zero rates. National interest rate policies thus vary drastically based on circumstances. Yet the US capital market now demands a 5% yield on 30-year treasuries. This implies one of two possibilities. Either the market believes US economic growth will soar over the next 30 years, enabling effortless 8% plus investment returns, or it fears the US will sink into prolonged high inflation and currency devaluation akin to Turkey, locking in permanently high rates. Beyond macro analysis, consider the timing. With 30-year yields breaching 5% in late May, Treasury bonds issued in June will inherently carry higher rates. The US national debt, already over $36.2 trillion in 2020 for approximately $107,000 per American, has been manageable due to low interest rates. The federal government paid just $338 billion in interest in 2020. But replacing low-rate debt with 4% average yields would spike annual interest payments to $1.4 trillion, a $1 trillion increase. This is pure expenditure, no welfare, infrastructure, or defense benefits, just wealth evaporation. To contextualize, US federal revenue in 2024 was $4.92 trillion, while even its massive military spending $997 billion remained under $1 trillion. Adding $1 trillion in interest payments would push the government toward fiscal insolvency, requiring spending cuts equivalent to the entire defense budget. Yet Trump, upon taking office, failed to slash spending, unwilling to raise taxes, and even promising domestic tax cuts in his campaign, leaving tariffs as the sole revenue gambit. But higher tariffs fuel inflation, prevent rate cuts, necessitate costly new debt issuance, and drive interest payments higher, often exceeding tariff revenues. Trump's dilemma is stark. No escape from spiraling costs. Lowering treasury yields requires taming inflation to enable rate cuts. Otherwise, hyperinflation could collapse the economy. For US-China competition, China's retreat from the no to US debt holder position marks not just a balance sheet adjustment, but a reconfiguration of global power. Soaring treasury yields expose the unsustainability of America's economic model, while global central bank sales of treasuries signal an irreversible de-dollarization tide. China's strategy, reducing treasury holdings, increasing gold reserves, and advancing RMB internationalization, represents a breakthrough in this financial war. When a nation no longer relies on another's monetary system, true economic sovereignty begins.